We're going to get right to the pleasantries here. We have Mr. Rod Scheer from Copper Mountain. He was a founder. You're still the CFO, as far as I know. Rick Van Nieuwhuysen, who everyone here probably knows from the years. He's the CEO of Trilogy, operating in Alaska. They got one of the highest grade copper deposits anywhere in the world. And a newly listed company, Kucho Copper, British Columbia. And you guys raised real money, about $45 million, just IPO'd. And we're going to talk about copper and a little bit about their companies and what they're doing. So first of all, we look at the copper price. Anyone that just saw my talk, forgive me, there's going to be some repeat slides, but copper has done very well, and I can articulate that many companies are now looking to grow. It's hard. There were groups in the bear market, many people were looking at projects. The decoupling here between the the gold price and the copper price. Quick question, let's answer these things as quickly as we can, guys, to give these guys more answers. But Rod, you guys just picked up a project and you looked a long, long time. Are these on? Yeah, that's on now.
There we go, good. Yes, we announced in November the acquisition of Altona Mining. It's a permitted project down in Queensland. It's going to be around $300 million to build. We probably went through about 130 projects on our review, and maybe 5, 6 were on our radar, in our wheelhouse and financeable. But to find something that's permanent and ready to go is very, very challenging.
Rick, you had South 32 was a group spun out of BHP, and they're investing over phases $150 million in your project?
Yeah, so it's an option. It's a 3-year option period, and we'll spend their money to explore and develop the project a bit further before they make a decision to spend $150 million for 50% interest. And that's enough money to get both our Bornite and Arctic projects through feasibility, through permitting, and have money left over to start building the first mine.
Perfect. So if you take a look at the screen here, Vince, the chairman, or the chairman of Codelco, the world's largest copper company, was suggesting that 2018 we may see $4.50 a pound copper. That's the all-time high on copper. Vince, you guys just acquired the Kucho project, and you're doing economics. I think your pre-fees is at 275 copper. So it's a number with a good margin. Why did you guys pick up this project? Where do you see the upside? How are you involved?
We picked up this project, and after again a long review period in evaluating an asset that we were after, and a more advanced stage asset in the space, and the criteria was, we wanted something with grade, obviously something with some meat on the bones, but also something that we could pick up and really unlock that value, and if you will, and had significant upside potential to it. And that was Kucho. We really did think it was a diamond in the rough. It had been sitting, buried within Capstone's portfolio for a good part of 7 years, and prior to that was sitting with Stephen Quinn in Sherwood Copper before the amalgamation. And Kucho never really got its chance to shine, if you will, and come to the forefront, and that's what we're going to be doing with it now.
Okay, so we're looking here at the price of oil over a long run, and now I'm going to superimpose oil and copper together. So if you can see through there, basically the highs are with the highs, the lows are with the lows, copper has decoupled, oil has rebounded, but in the long run, is there any reason other than politics for oil to be $100 a barrel, $150 a barrel? With copper, it's economics. It's impossible to build a project at low copper prices. Totally different. So if we look at these takeovers here, never mind the noise, there's 30 juniors that were taken over in the last cycle between 5 and sort of 10 cents per established pound in the ground. Does that make sense? You can value gold this way, you value copper that way. Going through quickly, what was the metric you used to buy Altona?
We end up paying about 1.2 cents per pound in the ground, just to give you a comparison to the deals that you were talking about. But we take an NPV, discounted cash flow point of view. We have good operating experience and costs at our Copper Mountain mine here in Canada, so we take a cash flow point of view to any acquisition.
How about you, Rick? Your project's trading at what kind of multiple right now?
Oh, geez, we're way under. We're like 0.05 cents per pound if you add up all the pounds. Okay. Yeah, it's a ridiculously low valuation right now.
And how about you, Vince?
And again, from an MBV perspective, I think given the comp set, we're trading at 0.2.5 times NAV, with an average in the space maybe trading at about 0.5 times NAV. So significant upside, I think, available.
So just to make this clear, you're looking for the opportunity here in copper. We believe the copper price should trend higher, yeah? There were 30 takeovers in junior copper between the year 2006 and 2012 when the copper price averaged about $3.50 a pound. Okay, copper is $3.20, $3.25. Rod just picked up a project at about a penny a pound in the ground. Rick is trading at half a penny a pound in the ground. Those buyouts were half a penny to sort of 10 cents. So there's the arbitrage. If you look at it on a P/NAV basis, like what's the value of the project, you always get a discount. You're trading at 0.25 of NAV. We look at the future of energy increasingly will be electricity. That electricity is going to take a tremendous amount of copper. And if you use a basic rule, internal combustion engine becomes more efficient, you use less oil. As we adopt into more electricity or make electricity itself more efficient, it takes more copper. They're directly inverse. So if you guys look at this slide internally, basically a future with more copper, is it fantastical to use $4 a pound copper as a sensitivity? Of course, you're not going to use it to raise money, but as a sensitivity, are you using $4 a pound copper now in sensitivities?
For sure. Yes, we are. I mean, you're at 320 right now, so that's not that far away.
Rick?
Yeah, well, we're just finishing a pre-feasibility study. It will be finished up this month. We don't need higher copper prices to make our project work. We'll actually do a sensitivity down to $2 copper, and it's going to look pretty good. But we will look at a sensitivity up at $4 copper, and it's going to look ridiculous.
Let me ask you, for you, Vince, I'm going to ask you the same question, though. So what's your MPV at $2.75?
At 275 copper, and I'm going to add $1.10 zinc. We are 60% copper, 30% zinc. We yielded a $265 million MPV after tax and close to a 28% IRR after tax. So highly sensitive to that copper price. Again, we looked at the sensitivities on the low side. It's a robust project. This thing gets built at 230 copper, but we've played with the numbers at $4 copper too, and it looks phenomenal.
So is that clear, the optionality that you have? Picture in the theater of your mind, you're a copper company and you're producing copper, and it costs $1.50 a pound or $2 a pound to produce the copper. When copper was $2, you made no money. Copper goes to $2.20, the torque involved. There's a tremendous amount of cash flow that all of a sudden appears. So when you're talking about a discounted cash flow model or in a P/NAV of any project, it's all gravy now. So price inflation with copper all goes to the sort of the bottom line. And I will refresh everyone's memory. Inmet Mining in the year 2001, it was a Canadian copper production company, was trading at about $2 a share, $3 a share. It peaked out at 110. Tremendous amount of torque, yeah? So here's a picture of an open pit copper mine, and the world's oil supply comes from 4,700,000 individual oil wells. As we adopt from fossil fuels, we're going to go into more copper. Most people don't appreciate or recognize that 50% of primary copper production comes from only 25 mines. It's a very big deal. So my question to you guys, all three of you, when you talk to the majors, I understand from my dialogue traveling all over the world, they are all looking for growth. Some of them have this internally. We all saw that First Quantum came in as an option on Pebble, right? Even though you're brand new, you're recently financed, and you just acquired someone, do you believe that your strategy, you yourself, could be gobbled up by someone looking for growth?
I think that's always possible, and we had a three-pronged strategy when we went forward: is build the mine as quick as possible, let cash flow pay for future growth, grow organically, and grow through M&A. And I believe with the acquisition of Altona that comes with a land package 50 times the size of Copper Mountain, we not only have the next mine, but we have the next mine after that we'll find ourselves, and that'll be cheap because you already own it.
I think what's really a big problem in the industry for the copper producers is what is going to be that growth. The big mines like Grasberg are transitioning to underground mines. Chuquicamata in Chile is transitioning to an underground mine. That won't go smoothly. It never does. Indonesia has the other effect that it's actually in Indonesia, and that's got its own political issues, like the Congo. So I think the major companies are really struggling to find projects of quality in safe jurisdictions, and I think that's what we offer, and that's what I think that's why Sal 32 is our partner.
You guys are brand new, Vince. Are you? I mean, that's almost a possibility. As you de-risk your project, it's.
Yes, I agree, and I agree with the comments. Stable jurisdictions, etc. And yeah, we've got some work to do. I think one of the opportunities with Cucho at this point in the current PFS, at 10.5 million tons, some might say a little small for that, but that is one of the reasons we acquired this project, because our goal will be to double the size of this and show the market that in the coming 12 months plus. And if we start getting into that category north of 20 million tons, yes, it becomes an opportunity for M&A and of interest to people in the market.
Let's all look at this chart here. Very unscientific. I did it with my 10-year-old niece. Demand for copper has grown at a CAGR rate of about 3.5% since the year 1900, up and down. The supply and demand differential is extremely important. It's like musical chairs. So we all remember a 2 million barrel a day differential in the price of oil collapsed the price by 70%, 70%. We're at a pivot point right now. We thought this would occur in the year 2019 or 2020. We are in deficit as we speak. We were last year, we were the year before. Last year by 100,000 tons, okay? Demand, in my opinion, is going to grow stronger because of the electrification of energy. Let's look at supply, very unscientific. Supply is going to decelerate at a minus 3.5% CAGR. It is in this delta that you will speculate in copper. You will speculate. We are closer to the bottom than we are the top. And it's all about grade. There has been no fracking renaissance in the copper mining business. We invested a lot of money, $150 billion in the last cycle. We didn't find a lot. It's all pretty much low grade. This is 0.5% copper equivalent, that blue line. These are things that are in production or could be in production. I move up the food chain. The highest grade outlier is, of course, Robert Friedland's Kamoa. I'm getting to a point here. In 2010, the average grade that went through the mills of the world, the top 15 producers, was 1.2%. Last year was 0.72. If you're in Chile, you mine 30 million tons, you now have to mine 42, 45 million tons. Rick, the grade of your project, just explain the scale of the grade and how much it is, how much higher it is than the average in the peer group.
Yeah, so Arctic, which is one of our two projects, is 40 million tons of 5% copper equivalent in an open pit mining scenario. It's 10 times the grade that is being mined around the world in open pit mines. So we don't need a higher copper price. We just need people to be interested in copper, and I think that's what we see going on. Bornite is 1%. It's the second project, 1% in open pit and 3% underground. So these are high quality projects, and that's what's really missing in if you look out across the copper space, you'll see a lot of 0.3, a lot of 0.4, 0.5 copper deposits. Nothing wrong with them. They're good quality projects, but grade is king in our business, and that's what's really driving the economics of the copper price.
Let me just articulate a point here, guys. I think it's important for the crowd to recognize, because Rod's Copper Mountain is a well-known, successful copper project here in British Columbia. What's the average grade there, Rod?
We're in the 0.35 range. I mean, typically Canadian mines are lower grade bulk tonnage movers in copper.
Absolutely, and you're about 1.2%, correct? With the zinc credit.
We are just over 2% copper at Cucho. With the zinc credit, we're just under 3% copper equivalent. So, and that was, again, we were looking for something with grade.
I'm going to show, the next slides are extremely important if you are not a geological engineer. If you're not a geological engineer, I need to articulate why I believe the copper price you're probably going to see a 5 on the copper price. Let me show you how. If this is 1% copper ore, and copper's trading at $3 a pound, that ton of ore is worth $66. That's all you got. You don't recover all of it, and you got to pay penalties and different things to smelters. The future of copper is 0.5%, 0.5. The value at $3 a pound is $33. At $4 a pound, it's worth $44. Now that's fine. Copper Mountain's in production. It's a margin. They make money. Rod will articulate this to you. But for a new project and the future of the grade, 0.3% copper at $5, that ton of rock is worth $33. Is 0.3 copper only with no credits, Rod? Can you make a margin building a new mine unless it has a $5 bill on it? You've already done the process.
I think you have to look at what other products are in
No,
there.
that's the grade. Only get 0.3.
Yeah, 0.3 copper. It's tough. It's very tough. There's no question about it. But if you have some byproduct credits, that does assist.
Anything to add there, guys? Probably not. You guys are both higher grade. The point I'm trying to illustrate is the future resources and reserves in copper, that is the grade. It's 0.2 copper with a credit, 0.3 copper. British Columbia is 0.3, 0.3. If we're going to have 45 to 50% new copper demand, and I believe that's where we're going, it's the math. It's the math. So your task here now is to look at the optionality. That's why you're here. You're not at Rio Tinto's presentation. You're buying pounds in the ground and the torque involved with those pounds in the ground. You have their metrics. You can look at the peer group, and I think that's what you need to do as you're looking at copper companies. Use a conservative case, but you also have to use a sensitivity scale and wonder, what would this be worth in a world with $3.50 or $4 or, dare I say, $5 copper? Of course, I'm suggesting to you that you're not here to make 50% on your investment. If you're speculating in higher future copper prices, your job is to look for the ultimate copper investment. And I think you should chat with the gentlemen, get their information, and we have time for one quick question.